Let's be honest, financial charts can sometimes look like an intimidating web of lines and colors, right? But what if you could actually read them? Kind of like a story. Well, today, that's exactly what we're going to do. We're going to decode the market by building a simple toolkit. Let's dive in. Yeah, if you've ever stared at a stock chart and just seen a big, old, chaotic squiggle, trust me, you are not alone. It can just feel like a random mess of price bars and weird lines going everywhere. But here's the secret. Inside all that chaos, there are actually signals. And today, we're going to learn how to find them. And we're going to do it by building a simple 4-part toolkit together. Think of it like this. Each tool has one specific job. First, we're going to find the trend. Then, we'll figure out its speed. After that, we'll confirm it with volume. And finally, we'll put it all together. Okay, first up in our brand new toolkit, finding the trend. This is basically our compass. Before we do anything else, we have to know which way the wind is blowing. Is the market generally heading up, down, or just kind of going sideways? So the most fundamental tool for that is the moving average, or MA for short. What it does is it takes all those wild up and down price swings and just smooths them out into one single, easy-to-read line. The rule here is super simple. If the price is trading above that line, the trend is generally up. If it's below the line, well, the trend is generally down. See? It's our first best step to just clear away all that noise. But, not all moving averages are created equal. The standard MA is kind of like a big cruise ship. It's slow, it's steady, and it's great for seeing the long-term journey. The EMA, on the other hand, the exponential moving average, that's more like a speedboat. It reacts way faster to what's happening right now, which can help you spot potential changes in direction a little bit earlier. So long-term view, the MA is your friend. Trying to catch shorter swings? The EMA might give you that earlier heads up. Okay, so our moving average told us the direction. But how reliable is that trend? Is it a powerful current or is it just a weak little drift? That's where the average directional index, or ADX, comes into play. And this is cool. It doesn't care if the trend is up or down. It only measures how strong that trend is. And the magic number you're looking for here is 25. An ADX reading that's above 25 is a signal that a pretty strong, reliable trend is in place. If it's below that, the market is probably just chopping around. So this little number tells you how much faith you can really put in the direction you're seeing. All right, part 2 of our toolkit. We know the direction, and we know its strength. Now, let's figure out the ride itself. How fast are we going, and how bumpy is it? For this, we're going to need our dashboard gauges. So first up, we've got Bollinger Bands. These are just 2 bands that kind of wrap around a moving average. When the market is super calm and quiet, the bands squeeze in really tight. But when things get wild and prices start swinging all over the place, those bands expand way out, basically screaming at you that volatility is high. It's an amazing visual for seeing market turbulence. Next up is one of the most popular tools in any trader's kit, the Relative Strength Index, or RSI. The best way to think about it is that it measures the engine power behind a price move. It gives us a simple score from 0 to 100 that helps us spot when a trend might be getting exhausted, running out of steam. And here's the first key level for the RSI you gotta remember. A reading above 70 suggests an asset is overbought. Now, this doesn't guarantee the price is about to crash, but it's a huge warning sign that the upward trend has been really strong, really fast, and, well, it might be running out of new buyers. The engine could be overheating. And on the flip side, of course, we have 30. When the RSI dips below this level, it suggests the asset is oversold. The selling has been super intense, and the downward trend might be losing its power, maybe even setting up for a bounce. It's a signal that the bears might be getting a little tired. Now, RSI is kind of the rock star here, but it's not the only game in town. You'll see other tools like the MACD, which looks at the relationship between 2 moving averages, or the stochastic and Williams %R, which compare the current price to where it's been recently. Look, don't worry about all the complex names. They're all trying to answer the same fundamental question. Is this trend running out of gas? They just use slightly different math to get there. All right, on to our third tray, volume. I like to call this our crowd counter. Think about it. A price move is way more convincing if a whole lot of people are participating, right? Volume tells us if the crowd is really behind a move or if it's just a few people making a lot of noise. High volume is confirmation. It shows conviction. And the simplest tool for this is on-balance volume, or OBV. It's just a running total. On days the price closes higher, it adds that day's volume to the tally. On days it closes lower, it subtracts it. So if the price is rising and the OBV line is rising right along with it, that confirms strong buying pressure is driving this thing. It's a fantastic confirmation tool. And just like with our momentum tools, there are other ways to measure the crowd's conviction. You've got Chaikin money flow, which tracks if money is flowing in or out of an asset. Then there's the VWAP, which is a special moving average that pays more attention to the times when trading was really heavy. They're all just different ways of asking, is this move for real? So we've filled our toolbox. We've got tools for the trend, for volatility and momentum, and for volume. But here's the thing. The real magic happens when you stop looking at them one by one and you start using them together to build a complete picture of what's going on. So here's how you put it into action. Step 1, find the trend. You pull out your MA and your ADX and you ask, which way is this thing going and how strong is it? Step 2, gauge the ride. Use your Bollinger Bands and your RSI to ask, okay, is the trend getting tired? And finally, steps 3 and 4, confirm with volume. You check your OBV to see if the crowd is actually on board. See, each step builds on the last, giving you a much clearer picture. And if there is one thing you take away from all this, please let it be this. No single indicator is a crystal ball. An RSI signal all by itself, that's just a clue. But an RSI signal combined with a weakening trend on the ADX and declining volume, now that tells a compelling story. That is how a clue becomes a strategy. In the end, this toolkit isn't really about getting perfect answers or predicting the future. It's about learning to ask better, more informed questions of the market. It transforms that chaotic chart into a conversation. So, with these new tools in hand, the only question left is, what question are you going to ask the market first?